guys, welcome to the second episode of our podcast. Today we're looking at refinancing. Your home loan is one of your biggest financial commitments, and as your lifestyle and circumstances change, you still need to make sure that your home loan, as you have it, is the most suitable one for you. So today we're going to deep dive into when is a good time to look at refinancing. I've got Dylan Marinelli with me here today. G'day, Dill. How are you?
Yeah, going well. Thanks for having me. Very excited to be here, especially after the success of the first episode as well.
The massive runaway success of the first one. Yeah,
it was a cracker.
Cool. Well, let's get straight into it. Now, first things first, just to get us on the same page, what is a refinance?
Yeah, good question. So I guess a refinancing is for someone who is an existing property owner that has an existing loan.
Yep.
Most commonly owner-occupier or investor. Looking to make some changes to that facility. So that might be with their existing bank or more commonly going to another bank. So essentially changing that loan, with loan lender A and bringing that to lender B, for example.
And when you're refinancing, what are some of the benefits that you're looking for? What are you hoping to get out of the refinance?
Yeah. So the most common one probably at the moment, which is front of mind, is, lowering your interest rate or lowering your fees to save money. So when we're doing that for our clients, we're reviewing their existing setup. If their current bank's sort of not coming to the party with a sharp rate, that's when we go shop around. We've got 40 to 50 lenders we can choose from on our panel. So we'll have a good read of the market and understand sort of what options they're going to have. So reducing their interest rate, reducing their fees, improving their cash flow and lowering that repayment.
Just something you said there. So you'll talk to the existing lender first as part of the process.
Yeah.
And what are you looking for there?
Yeah, so that's part of our process is our ongoing annual reviews for our existing clients. So, we'll reach out to their bank annually, once a year. We're in touch with our clients quite a bit, so it might be every 6 to 12 months.
Yep.
But first point of call is always to contact the bank, see what they can offer. If they're not willing to make any changes with a lower rate or fees, then we'll shop around for them.
So we're essentially threatening the bank to...
in a nice way.
Making them offer they can't refuse.
Exactly right. Yeah.
In terms of the process of refinancing, what does it look like if someone comes to us and wants to look at
so it's a full application. Okay. So we'll want to have a good understanding of what our clients' position will be. So we'll sit down with them, have a discussion about sort of what their short-term plans are. That might be, for the short term, getting a lower rate to reduce their repayments, but also understanding what their longer term goals are. So we'll have an initial meeting with them, collect their documents, go out and understand sort of what their preferences are, put together our loan recommendation, which will say, we're going to lender A for, these reasons, applying that to the bank and doing a full application. So, bit of legwork involved, but definitely beneficial.
Cool. And any argy-bargy with the banks going from one to the other, is that something you need to worry about? Or?
The discharge process can be the thing that might hold up a refinance application, but if we're on the front foot early and we're notifying the bank early, it's built in with our process to get that started pretty quickly, so we don't cause any delays in, getting that rate down and helping with repayments.
Sure. So that's kind of covering off on the owner-occupied stuff. What about investment loans? What are you looking for a refinance for investment?
A big one. So, when client situations become a little bit more complex, they might have multiple properties, which might mean multiple loans or multiple banks. Reviewing the overall situation is really important. So we want to be able to, for example, for an investor client, be able to tap into some equity in their current home. So understanding what their property's worth. Each bank might actually value their property slightly differently. So, with the panel that we've got, we might get a valuation that may be 50 grand higher, for example. And that might allow that client to access enough equity to purchase that investment property.
Sure.
So understanding sort of how that system works is really important because, that might help them create that wealth through property investments. That's something they're looking at.
I know some of the guys have had a few examples recently where it's not so much refinancing for rates, but more for structure. So the clients have been set up not quite as good as they could be, and we're sort of writing that. Is that fair to say?
Very fair to say. Structure is almost as important as rate, if not more important. So, rate's obviously the hot topic. Rates, chasing a rate's not always going to give you, the right setup and structure moving forward. So having the right loan structure set up, especially if you're growing your portfolio, is really important. Some little things such as, refinancing at the loan term to assist with capacity might be something we factor in for our investor clients. Making sure they can actually still pay the loan off in a suitable time frame, but being a bit clever with how we structure the loan in terms of deposit and costs, facilities, making sure the accountant's happy with how we set it up.
Sure.
The banks do like to take hold of a lot of their clients' portfolios, so that's why we might diversify through lenders, different lenders, and different setups.
Spread the risk. Yep,
correct.
Cool. So we talked about owner-occupiers and investors, but what are some of the triggers that people should be aware of to go, okay, I should think about or look at refinancing or considering my options? What are we looking for?
Yeah, one of the more common ones we've seen over the last few years is the expiry of, these really sharp fixed rates.
Yeah.
So unfortunately, they're not around any longer, but, for a lot of clients who did fix during that period, they might have been on sub 2%. They're coming up to their expiry date. We'll get in touch with the client, or the client will get in touch with us. We'll start to plan for these increased repayments.
Sure.
So if it's a month or two out, we'll contact the bank, say this is what's happening. We're going from a 2 to maybe a 6. What can you do? Can we drop it? If they're not, then, there might be discussion around, we're going to go to a different bank because we can get something a bit sharper to help with those increased repayments. So the roll-off of the fixed rates is a really common one.
Sure.
Also clients who have built recently. So, some banks require 2 loans for the land and 1 for the construction.
Yeah.
If you've built over the last couple of years, especially in Perth here, with the uptick in value, you might have done that application at an 80 or a 90%. Now, 2 years later, your property's gone up in value, so we want to review it. Completion's done. Let's reval it, see where your LVR tier is, and maybe get a lower rate as well. So construction at completion is also a really common one.
So interesting you mentioned there about the LVR tiers. So the less the loan is a portion of your value of the property, the more access to better rates.
Correct. And that's across with a lot of lenders now. That's been introduced over the last couple of years. So when they're pricing on their interest rates, not only will they take into account the limit of your loan, or what the size of the loan is, they'll also want to see, what the loan to value ratio will be. So, a little bit less risky for them means they'll give you better terms.
Makes sense. Yeah. Makes sense. What about in terms of lifestyle changes, or the example I'm thinking of is if someone's thinking of going from an employee to self-employed, we would want to be looking and planning the finances around that ahead of time, wouldn't we?
Yeah, spot on. So, we're in frequent contact with our clients. So, we sometimes we're part of their lifestyle decisions, whether that's personal or business or whatever that might be. So, we always tell our clients, give us a fair bit of notice as to significant changes in your position. So, for example, if it's someone that there might be a change in employment, whatever that might be, get in touch with us. Let's have a discussion about what the impacts of that might be for future lending. Another significant lifestyle one might be, starting a family, for example.
Sure.
So going down to one income for a period of time. There might be some ideas around extending the loan term out for 30 years, maybe going on to an interest-only term for a couple of years. Now, these are short-term solutions. We want to see the debt paid off eventually, but for cash flow during that period of a couple of years where there might be one income, if it can help with reduce the repayments, a few $100s or a few $1,000s per month, that's a big difference during that period.
If you're having kids, I guess the last thing you'll be stressing about is your finances. Correct. So best to have that squared away beforehand if you can.
And it's we're part of those milestones with our clients. So we try to plan for them as best as possible, but not always the case. But these are little tricks that we can implement just to make sure our clients are prepared for these changes.
We talked about rates and fees as a trigger for refinancing, but there's been a couple of examples recently where people have come to us and they're not quite on the right product. So talk us through what that might look like in terms of features of a loan.
So the most common ones, having the offset account or the offset feature available. So especially for our owner occupiers, making sure that they're on the package, which most common banks will have at the moment. So we'll set them up with an offset account. And then in saying that, also some of our investors don't necessarily need an offset account. So, pending whatever that bank offers in their package, we might remove that, save them on, additional fees and charges they don't necessarily need. So every bank's going to have their suite, of products, but, making sure it's still suitable is the most important.
So it could be dialing up the complexity to suit their needs, or it could be simplifying it and winding it back.
Yep, correct. Cool.
Put you on the spot from a maths point of view. If we're looking to refinance, say, an investment loan, if we're refinancing from one to another, what's a garden variety saving you might get from that? What are the numbers on that?
We with a lot of investor clients, in-house, we're doing a lot of this. So simply, same thing as if it's, $800,000 loan, one that we've done recently last week, we're able to save, around 30 basis points on a rate reduction, 30 to 40 basis points. That's saved the client about $300 to $400 per month.
Okay.
So almost, $3.5 grand, $4 grand per annum. Just for that one investment property. So for someone who's got multiple, cash flow is really important for our investor clients. So these changes, if we're doing, these reviews every 12 months or refinancing every couple of years, and we can save, $3,000 to $4,000 on one property,
money,
that can free up some cash flow for other other purposes.
Yeah, and obviously the saving is one part of it, but what about the costs? What was it? What are we weighing up?
There are costs involved with the refinance. So as I touched on before in terms of, rate and fees, we'll have to weigh up a few things. Whilst it's always good to get a lower rate, we need to make sure that reduction in rate or reduction in fee outweighs the entry and exit costs of a refinance. So the most common ones, the government's always going to charge you your registration, your deregistration of your mortgage. Yep. So that's essentially taking the old bank off, putting the new bank on.
Yep.
Some banks will charge you an application fee or a legal fee, could be a couple $100.
Yep.
And your existing bank, 99% of the time will charge you a discharge fee. That can range from a couple $100 to $300. So you're probably looking at around $1,000 to $1,500 in potential. Yeah. So when we're looking at, for example, for owner-occupier refinances, where it's just a straight refinance, maybe a reduction in, same loan amount, reduction in rate, we want to make sure that there's, savings of at least $1,000 to $1,500 in the first year at least. Yeah.
I guess that's where long-term planning comes into play as well. Because if they're going to keep the place for 1 year and sell, it's not really worth the exercise.
Yeah, not worth it in that case. And that's where, we're pretty upfront with our clients about that. Whilst we want to get them a lower rate, if the fees are going to outweigh it, then for the short-term benefit, then maybe it's best we sit tight until there's another reason to do it.
Cool. Let's look at some of the common traps of refinancing, because sometimes you see people refinancing perhaps more often than they should or more than is prudent.
Yeah.
What are the things to look out for?
Yeah, so rate hunting is the biggest one. So like, as I said, we want to make sure there's an actual benefit in doing the refinance. Yep. So not just refinancing for the sake of a lower rate. Actually have another benefit for doing it. So that would probably be the most common one. The other one is if people have a fixed loan, for example, or maybe their facilities are split, a variable and a fixed, and they're unaware that when you have a fixed loan, there is potentially some substantial exit fees involved. So we want to make sure we've got an idea of the overall situation. Another one, which is, can be a bit tricky, but, sometimes banks will want to use multiple securities for one loan. So they cross-securitize a facility. This does catch people out a lot. Can be quite complex, but we always want to have an overall understanding of what that setup will look like. So just making sure there's not multiple securities involved when completing a refinance is really important.
Making sure it's clean.
Yeah, most we see that more commonly when people go bank direct and then they come to us. Yeah, sure. Which is fair enough. That's how the bank will structure it, but stuff that we definitely look at when it comes across our desk.
You mentioned before as well about extending the term for short-term cash flow purposes, but there's a downside to that.
Definitely downside, Because essentially if you keep kicking the loan out to 30 years, you'll pay more interest. So whilst we say we might extend it out for a short term, it might just be for a pure cash flow play. But what we want to be mindful of is, maybe after that 12-month period or 6-month period where cash flow eases, you want to go back to making your higher repayments. Yeah. So get back in line, get back in front of making your repayments, and then, your term gets back to that, for example, the 27-year remaining term. Because if every few years, 2 or 3 years, if that's the case, if you refinance it back out to 30, your loan term starts again. Yeah. So we don't want to be just kicking it down the road. But as we said, there's a benefit in doing it for some clients if it's just for a pure cash flow play for a short period of time. And then I guess you're talking about making additional payments or use of offset accounts. Use of offset account, facilities. So. Offset accounts, the biggest one. Any savings just to sit in that, which will offset every day. So that's the big play there. Mate, thanks, mate. We're just about out of time, but one question before we go. What's the number one tip you tell someone before they would consider refinancing? Planning. So it's a pretty common one or a very popular one, but plan not only for the short term but also for the long term. So actually have an understanding of what you're trying to get out of the refinance. So we might refinance someone's property to get the lower rate, but then there'll be a discussion about, okay, we've got this equity here. Do you have any other plans? So are you looking to do some renovations to the property, or are you looking to get into the investment market, or has your advisor told you to potentially, I'm talking financial planner or accountant, have they advised you to, access some equity to put into the stock market or manage funds? So, we'll work pretty closely with our clients' advisors, both financial advisor and accountant. Making sure the setup's critical is really important, but plan. Yep. We'll document it all. We'll make sure everyone's on the same page. But getting a plan in place is really important. Beautiful. That's all we've got time for this week. Dill, thanks very much for being on the episode. Thanks for having me. It was good fun. Hopefully I'll be back in a few weeks' time to chat again. Rostered you on already. Don't worry about that. Sounds good. And thanks very much for watching.